Hello, my name is Camilo Mateus, and this is my project presentation for Financial Engineering Analytics. It is focused on portfolio optimization, and this will be the agenda that will be followed through the presentation. First, an introduction and brief review on some financial concepts along with the methodology used for the project. Second, we will see the stocks chosen for our portfolio and some of their stats and plots. Then we will get to see the importance of efficient frontier and diversification in portfolio optimization. And finally, a quick summary of the findings and some of the sources and works consulted. So for introduction and methodology, here we have some key concepts that may appear later in the presentation. Investing is the act of allocating resources, usually money, with the expectation of generating an income or profit. So there is an expected return, but there is also a risk associated with it. A stock, sometimes called equity, is a security that represents the ownership of a fraction of a corporation and is usually bought and sold on the stock exchange such as New York Stock Exchange, London Stock Exchange, Nasdaq, Euronext, among others. A portfolio is a collection of financial investments like bonds and stocks, and it may also include commodities and cash, but these are not usually the predominant ones. The modern portfolio theory, first pioneered by Harry Markowitz, is a theory on how risk-averse investors can construct portfolios to maximize expected return based on a given level of market risk. So here we have this graph, volatility is related to risk, and here we have the returns. And there is also the concept of efficient frontier. This is the set of optimal portfolios that offer the highest expected return for a defined level of risk or the lowest risk for a given level of expected return. So that will be located like around here. This red line is the capital market line. We will get to see it later. So portfolios that lie below this efficient frontier are suboptimal because they don't provide enough return for the level of risk, while portfolios to the right of the efficient frontier are suboptimal because they have a higher level of risk for the defined rate of return. Diversification is a risk management strategy that mixes a variety of investments within a portfolio. Portfolio constructed with different kinds of assets will yield higher returns with a lower risk, and the benefits obtained through diversification are graphically depicted by the efficient frontier. Like it shows that it's not a linear relation between risk and return. Also, we have this concept of the Shapiro ratio. This is expressed on this equation here, where RP refers to the expected return of the portfolio, RF to the return obtained by a risk-free asset, and sigma p is the standard deviation of the portfolio, that is the volatility. Now, the methodology to develop the project first included a revision and selection of stocks to incorporate in our portfolio. For this, the S&P Standard & Poor's 500 index was examined, and the stocks data was gathered from Yahoo Finance for a range of 10 years. Some of the some stats were computed for the price of the stocks chosen and their returns, including a few charts that will be shown later in a few slides. And the calculations were made primarily on Python using the Jupyter interface and Microsoft Excel, just to check a few of them. After that initial statistical descriptions, some simulations were run. Like I assigned a random initial weights and then run simulations on Python to get the efficient frontiers for the portfolios. And diversification was tested with multiple combination of the considered stocks. We will now see which are those stocks. So, well, stock prices and return statistics. This is a snapshot of the first 5 rows of data collected. It corresponds to the adjusted closing price of Halliburton, Chevron, Toyota, Honeywell, IBM, Microsoft, Amazon, Walmart, and Netflix. So, as you can see, we have stocks from companies in a variety of sectors. We have energy, industrials, information technology, consumer, discretionary, and consumer staples, communication services. So, well, that is something good considering diversification concept, and we'll later come back to that. This is a plot of our 9 stocks. Here is the legend. Over time, in the 10 years range considered, it's clearly seen that Amazon and Netflix share these colors, um, are the ones with the highest stock prices, while Walmart, you can see around here, Walmart Halliburton has the lowest prices. They are on the lower side. Now on this graph, this is the same plot as we saw on the previous slide, just that it's plot on a log scale on the y-axis. Here it can be observed that Netflix has some important fluctuations over time. It's not like very stable, unlike uh, let's say Toyota, this green line, or Chevron, the orange, or Walmart, which is about here, this gray. So this is something that must be considered when investing, since large fluctuations may represent a higher risk. And this chart, let's take a look now to the returns. So on this chart, there are some big spikes on the yellow and some of these blue lines. These are associated with a high volatility on Netflix and Halliburton stocks, and well, this agrees with what we have seen on previous plots. Also note that we are not looking at the simple returns, but at the log returns instead. This is due to the benefits that they offer, which make them commonly used in financial math. Like log returns can be added across time periods, and they tend to follow a normal distribution, which is helpful since much of classic statistics presumes normality. We'll see later. This table presents a summary of the log returns for our stocks. So, well, we already have the names of all of them. We can see that Walmart is the one with the lowest volatility, standard deviation, while we have here Halliburton and Netflix have the highest volatility, and the rest are somewhere in between with similar values. So we can also see that the mean for the log returns of all the stocks is positive, which is something good. So we are looking to invest on them. And these box plots, these are used for 3 of the stocks, for Halliburton, Chevron, and Toyota. And well, it's just a graphical representation of what we just saw. This small point black is the mean, the green line is the median, and well, we can see like how the log returns change different in between some stocks. Also, the histograms shows that there is a normal distribution. So that is what we're talking about previously. This is the correlation matrix for the log returns. We can see that there is little to no correlation among these values for the stocks considered, and the computed yearly expected returns based on historical data along with the volatility for each of the stocks represented on this table. Um, we will maybe come back to this in a few slides. Just like remember how are the values, like okay, and now to the fishing frontier and portfolio diversification. So well, this is the result of the portfolio simulations using the all the 9 stocks considered initially. The purple diamond represents the portfolio with the highest Sharpe ratio found on the simulations. The weights of the stocks in the portfolio for this case are the ones here on the pie chart on this side, and that will be the optimal risky portfolio, and the capital market line passes by this point. Another portfolio that may be important is the one with the minimum volatility or risk, if it wants, yeah, you want to use that word, and is the red diamond. It represents the lower risk, the portfolio with the lower risk associated. However, as we can see, this doesn't have very high returns. It's not the lowest, but it doesn't have very high returns. And well, on this slide, we can see in more detail the weights per stock, the expected returns, and the volatility and Sharpe ratio of the two mentioned portfolios, the one with the minimum volatility and the one with the maximum Sharpe ratio. So obviously this one had a volatility of 0.118 and Sharpe ratio of 0.56, and this one a volatility of 0.16 and a Sharpe ratio of 1.3. Uh, Important difference. So let's keep these values in mind. We will now see some of the combination, try to test the effects of portfolio diversification. So for the case of two stocks, let's just consider Chevron and Toyota. And well, since this is just two stocks, the curve can be easily appreciated. Again, the purple diamond represents the portfolio with the highest Sharpe ratio, while the red one represents the portfolio with the lowest risk. The pie chart shows the distribution of the stocks for the optimum portfolio, the one in the purple diamond. That is well, the one with the highest Sharpe ratio. And okay, we see these distributions 30, 70%. This is now for the case of three stocks. So let's now consider also Honeywell. So we have Honeywell, Toyota, and Chevron. We recall the table shown earlier with the expected returns and volatility uh, at the year, like annually. It makes sense that Honeywell has the greatest part of the pie chart since its volatility is similar to that of Toyota and Chevron stocks, but its returns are about the double. So it makes sense that there is a lot of weight on this portfolio assigned to Honeywell. We can see the simulations in here. Um, Again, purple diamond and red diamond, highest Sharpe ratio, lowest risk. Here's the scale that was shown in all previous plots too. This is the case with the four stocks. So let's now consider also Netflix, and recall that Netflix had some of the highest returns, but also had a great volatility. So it makes sense that Honeywell is still with the highest weight for this portfolio, given the highest volatility on Netflix. Adding more stocks will make any analysis on the weights assigned to each stock more involved, but the results like we got so far are useful for our testing of diversification. So again, what we've seen on the three previous slides, this will be like the efficient frontier up here. And let's see this. So well, for 2, 3, and 4 stocks, the minimum volatility portfolios and maximum Sharpies ratios. So as it can be seen, by increasing the number of stocks, we get to find portfolios with even lower risk and higher returns. So here was 0.15, and then 0.14, 14.2, but like the Sharpie ratio increases from here to here, the returns increase, increasing the stocks. And in this case, it's the same. We get a even highest and greatest Sharpe ratio in each case. So, well, the results are pretty straightforward. And in summary, well, a lot of simulations were run on Python to plot efficient frontiers and find better combination of weights for the stocks considering the portfolios. The stocks also had an statistical analysis first. It got some univariate statistics and a few bivariate statistics. Also, the effects of diversification and portfolio optimization were tested, and the results, well, or the results as we just saw. Basically, more stocks, that is less risk and higher Sharpe ratio. And well, an optimum portfolio including the all the 9 stocks was developed. These are the source consult, and thank you very much for your time.